Let me know if you can hear me. Facebook's made some updates, so live doesn't quite look the same as I used to see it. So I want to pop on here and I want to talk a little bit about your taxes, how you can prepare, how you can start to really put framework around what you need to do, and hopefully give you some questions and some takeaways that you can go to try to help better your tax situation. Um, Before I jump into that, definitely appreciate number one, you guys' overwhelming support. Yes, I just had a little baby girl. Love just everything about her, spending time with her, being able to help. And you guys will see content about what we'll do for her financially, how we'll switch that up, and hopefully that can be helpful for you as you plan for your kids. Um, that sagging, like I said, technology kind of knocked me off a little bit. Definitely appreciate the continued growth. Invite your friends to the group. Invite your family. It's so important that we have a financial conversation. And the whole point of what I'm trying to do with the group is not just to meet you where you are and go and help you build wealth, but I'm trying to get you the information to help you know what you don't know. I see this stuff every day. I work with it, I understand it, but a lot of times when you're trying to get a handle on your situation, you don't know the things you don't know, and you don't even know what questions you should be asking. So that's why I want to start hitting a little bit harder with some of these topics, start going a little bit deep so that you can at least get your mind churning about your particular situation. Like on Facebook if you haven't, subscribe, share, do all that on YouTube. Love to see the growth there. And like I said, on YouTube, it's really more to dive deep further. So definitely appreciate you guys being a part of the group. I appreciate the questions, the comments, the likes, the even share posts, however you participate. Don't forget there's a group book album that I typically, as I'm at reading books and as I find it good for people to look at their finances or helpful with their financial investing or what have you, I add that to that category. So hopefully that continues to grow. But there are several books that way. Each album has different topics just to get you going. And again, if you have questions, feel free to direct message me. Feel free to even toss it to the group, and we'll definitely, like I said, try to get your answer to you as quick as possible so that you're not waiting. So for a while, and I think it's only fitting right now that we talk a little bit about taxes, because one of the things that you really have to be concerned about with is investing tells you how to grow your money. Taxes tell you how to spend your money. And it's very important that whether you want to believe it or not, whether you want to do whatever you want to do with your money, the fact is the way our economy and structure is set up, you get benefits for spending your money what is deemed by the tax code the right way. So understanding how things work with the tax code, but then also what do things mean? Should you even be using an account? When should you use an account? These are some of the things I wanted to start with. So the first thing I want to discuss is: are you using like a H&R Block? Are you using like a TurboTax? Are you using a friend who has a tax business? Those things can be helpful. The average person in 2015 paid about $127 to get their taxes done. The average person typically has like a W-2, maybe one child, or two children, their kids go to school, that type of thing, same consistent job. $127 for that service probably wouldn't be that much, but typically people are charging you per the forms. And that's where you want to look at these tax services. They usually inflate their prices because that's how they make their money. So now that was, again, 2015. Now that price, the average person is spending about $300-$400 when their situation in the forms don't necessarily dictate that they need to spend that amount of money. So how do you know what you're supposed to use? If you are basically single with no kids and your job is the same and the only deviation that you've had from 2018 to 2019 is you just got a 3 or 4% increase from that same job, you likely could do your taxes yourself using one of the software, and you don't need to see a CPA. If you have kids if you're head of household, if you switch jobs, if you have business income, if you're married, it's going to be important that you don't go to a tax service, but that you go to an actual CPA. Number one is going to do two things. If you go to an actual CPA, you'll likely pay less than you're paying for a tax service. Number two, if you actually are and how they apply to you. Now, the thing about the CPA is the same thing with the investment advisor, is the same thing with a financial coach. All of them are created equal, and all of them don't understand fully how the rules are met. So it's important for you to really kind of research, really start to learn a little bit about your situation. Speak to some people, speak to some friends and family that who they use, interview them, see if someone can help you learn. Because if you've been doing a tax service or all this time, you could have simply left money on the table. And that's a big piece. The second thing I would point out to you, if you are married or honestly, if you're married, you need to be running your tax scenario in both a single scenario and a married scenario. And the reason for that is because if you're married and have student loans, well, understand that's taken into the account your whole household income when you're doing those income-based repayment plans. But if if you're married, you still have the opportunity where you could file single. And if you're filing single, well, that brings down your adjusted gross income, and that makes you a little bit more eligible, you and your spouse more eligible for, again, things like the stimulus check. The You start to control how much you're sending to student loans if you're on an income-based repayment, because that's based off 10% of your discretionary until they make a change where it may be 5% of your discretionary. But these things are important for you to know because, again, this is all about controlling your income. And you can get rid of debt, but you can't get rid of taxes. No matter what you do, you're going to have a tax liability, a tax bill. And you need to not be about avoiding taxes, but you want to make sure that the taxes that you're paying you don't want to evade your taxes, you want to avoid the taxes. You want to avoid meaning, hey, because I am taking advantage of this tax rule, I can deduct X expense. And the reason why audits and things can come up is if you don't keep your paperwork tight and understand how the rule can be implemented, that's where you get messed up. So that's why I encourage you really, really sit down, research, look at CPAs, and many of them will talk and discuss with you without even charging you, without even doing your taxes. Take a previous tax return. See what changes they have. You have up to 3 years to amend a previous tax return. So we're in 2021 and we're doing 2020 taxes. So that means you can go back all the way to 2017 to amend those taxes and get any potential credits, any money you left on the table. But again, you have to you have to know that and be confident that you're getting and paying the best tax bill for your scenario. And then you have to have the expertise in your corner, accountant, someone to help guide you to make sure that as situations come, you're being proactive in changing. So if you had a big increase in income from 2019 to 2020 or 2020 going into 2021, now is the time to be sitting down with your tax person to pre-plan for those things, not after. Keep in mind, it's not about the further you go up in income, it's not about your income and your tax refund. That should eventually dissipate. And the fact is, if you struggle with your budget, look at how much is getting pulled out in your tax refund. That's extra money you're sending. Maybe you need to adjust your allowances so you can have more cash in the month to decrease your liability. That's important because if you can go without that money, that's fine because it's always something to look forward to. But if it's kind of makes the difference in how you're managing your money by having that $3,000 or $4,000 every throughout the year every month, then that's something you may want to adjust your withholdings for. See, the thing about the tax code is it can be intimidating because there's so many rules, and then there's so many ways to get around each rule, and then there's so many what ifs. And the fact is, one thing that you want to be concerned with is you don't want to go all the way down to zero, because I want to caution you, if you try to run your tax bill to zero, well, if you have a tax bill, the next thing is going to happen is once you reach a certain threshold, you can have fees, penalties, and interest. So I don't want you to get out the habit of, hey, I got a $4,000 refund, and then the next year I adjusted all my withholdings, and now I owe $1,500, $2,000. No, but if you had a $4,000 refund, adjust your withholdings so at least you get an extra $2,000 in a year or $2,500 in a year. So that way you're not waiting on as much of a refund, and you can utilize that money throughout the year. Again, speak with a tax professional. These are just things to help get your mind going around taxes. What are some of the things that happen with taxes? Understand the difference between a tax allowance and a tax credit. And I'll put up a post later about this, but I'm sorry, a tax deduction and a tax credit. A tax credit gives you more value. A tax deduction lowers your adjustable income. So, what is adjustable income? You make $225,000 a year. Well, after you adjust for meals or itemize or gifting or your kids or child care, those are all deductions you take, and so you come down. That brings your income down that you will be taxed on to maybe it's 150 or 125 or mortgage, whatever it is. But that's what adjusts your income. A tax credit gives you more money in your pocket, and it actually means more in the long haul. If you have questions that I'm going through some of these items, feel free to leave it in the comments. I'll try to answer them while I'm on the podcast. So this is so important that you understand the not only the difference, like I said, not just if you're filing your taxes, so you understand how these things actually work. A tax deduction versus a tax credit. A tax credit actually means more to your tax situation. You should know what percentile you're in for taxes. The lowest is 10. The next up from that is 12. It goes all the way up to 37%. And your taxes aren't equal every bracket. So what does that mean? You pay from, and I made a post about it, but just for example, the 10% bracket is from 0 to 12,000. You only pay 10% in taxes on that amount. And then from 10,099 to 20,000 X, you pay 12% on that. And you do all that, all those different rates up until you reach your max income, whatever your tax liability is. So, what things can you do and look for from this? So, the tax changes, while they're announced, they're not always easily interpreted. So, one thing that I would encourage you to do is, number one, this year, Biden's plan is changing a little bit the way 401ks are actually taxed. And I did a video on this on YouTube, but I still want to mention it here just so you're aware. So all last year and even before, I preached hard about, hey, make sure you use the Roth IRA. Make sure you try to invest in that first, Roth 401k. Well, now it's affecting your tax advantage. So if you're in a 22, the 28% or 37% tax bracket, what Biden's proposing is a flat across the board 20.6% deduction that happens when you contribute to your 401k in the traditional. What does that mean? It means that you will actually, the deduction and that you're used to seeing for your taxes for contributing to your 401k in the traditional actually decrease. There are several videos, but I ran the math, and basically what that means is it's not going to be advantageous if you're above a 12% tax liability, meaning you're in the tax bracket of 12%, or I'm sorry, higher than 12%. It's not going to be advantageous for you to continue contributing to retirement in the traditional 401k, because your tax benefit for doing that has decreased and the math just doesn't make sense. This is a perfect example of number one that this is not something that got a lot of um, noise in the news. But when we're making these tax changes, this is something that applies to all of us that contribute to our 401k plans. Because you, again, the only way you'll see it is when you get ready to file your taxes. Well, I'm telling you this now so you can really start to think about, all right, what can I adjust? I can take advantage of the Roth 401k. I can take advantage of Roth IRAs. I can start putting my money in different places rather than contribute to the 401k because it's not going to give me as much benefit. And when you're talking about investing and when you're talking about your money, it really doesn't matter what you feel like doing as much as what is going to give to you the best value. And the best value means what is going to put more money in your pocket. It's very important that you understand these things because that's going to be your next step. And as you start to build wealth, it's always going to be about tax harvesting, losses, capital gains, real estate. Another thing that you need to be aware about, because this year has been huge for people buying a home. Well, when you buy a home, that creates a taxable event. And there's a document that's in that home that's not necessarily in that closing package that you need to have to, not that you're going to be taxed on it, but it basically, when you file your taxes, you're basically saying, hey, I bought a home this year. And that's what the government wants to see. But you're only going to get that document if you're only going to get that document if you look through your closing paperwork for when you closed on your home. You're not going to get it at the top of the year when you normally get your other tax documents. Other changes, the child tax credit is expected to increase to $2,000. That, again, can help you put more money in your pocket. And it should be so. One thing that you can see that already I'm seeing in the changes and the proposal from Biden's tax plan is that he really is trying to even out the table of how people file their taxes and the benefits that they get. So again, with the 401k, if you're in the 10% tax bracket, if you're in the 12% tax bracket, typically if you deposit $100, you're going to get a tax credit of about $10. Now, with this change, that means instead of if you deposit $100 into your 401k, you're going to actually get a tax credit of $20. That's, again, if you're in the 10% tax bracket, 12% tax bracket. Those are usually the lower income tax bracket. And that is, again, where a lot of Biden's proposals is geared. What questions should you be looking at for your when you sit down with a CPA? How do you know it's the right person? Well, one thing you want to know that they're credentialed. Number two, it never hurts to actually speak with people that they've worked with that you may know. Maybe looking around, checking for reviews. Questions you may have is all about if they found a difference, letting them review your previous returns, giving you a mock-up of what changes they would make, but then them actually articulating why you should get this tax rule, why this rule applies to you, to validate that. Nothing that they should do different should be anything that you question. And when it comes to your money, there should be no one you're doing any type of business with, and at the end of the day, you have questions. You should always feel confident about who you're giving your money to, especially when you're doing with taxes. But you're not looking at somebody who can do your taxes for now. You're looking at who can grow with you as you start to build out your wealth journey. Because you will buy homes. You will depreciate down your rental properties, and you want to make sure they'll be able to tell you, hey, before you buy a home, what is this going to do to my tax situation? That is a good pre-step to take so that you understand, is this the right purchase for me? Like I said, these are things that, again, I wasn't told, and I'm in the mortgage industry, but it's important that you know how to actually consider all these things. I hope this can help you as you start to look and formulate. And as I put together more packages of content to try to help give you some some type of resource to go through and have a discussion about your taxes. The the underlying thing is going to be clear. You need to have a good CPA in your back pocket. That's who you need to have in order to do your taxes. And that is going to help you for the long term. I know it can be scary, but the more you understand kind of the rules, you don't have to understand every nuance, but you do have to have somebody you can trust. You do have to have somebody that knows what they're talking about. And you do need to know how certain things may change you. The 401k thing, yeah, that's something that'll affect you right now. That's something you want to make sure you're getting on top of now. If you're buying a home, check with a CPA first. What is this going to do to my tax liability? What is it going to do to my financial situation in terms of taxes? Children increasing the income for that child tax credit, that's all valuable. Hope this is helpful for you guys. If you haven't already, if you're watching on YouTube, subscribe to the channel, like it if you like the content. And again, I can't wait to see you guys in the next video.